For more on bonds and rates, let's bring in Jim Bianco, president of Bianco Research. Jim, great to see you. We were talking about yields and what yields are doing. They go higher seemingly no matter what the narrative in the war is. What is the story of the yields at this point? What is the bond market telling us?
I think if you wanted to ask, do yields go up or down in general, you have to look at a measure called nominal GDP. That's real growth plus inflation, the two together. And I think what the bond market has been seeing here is a fear that we're going to get more inflation than we're going to get a hit to growth. And nominal growth is going to go up. That's why you've been not only seeing yields go up, but you've also been seeing all the rate cuts we were talking about disappearing. And now we're looking at the end of the year with small chances of rate hikes, not about 50%, but it was the day before the war, we were pricing in 2 rate cuts. Now they're gone. It's about more inflation than you will see in a slowdown in the economy. And frankly, it's not surprising because I was one, like many others, who was talking about the day before the war that this was a resilient economy, that it seemed like it was hanging in there and it was taking all the blows. And if it's doing that, then all we're doing is we're adding inflation to it.
Jim, the dollar plays into this as well, and it's a global yield story. I mean, it's going around all over the world. But the U.S. dollar, the resilience and the strength over the last couple of weeks, is it a flight to safety or is it actually something other going on here? Is this a sort of a change in direction?
No, I think it's largely a flight to safety because you've also been seeing it with some of the other flight to safety instruments that I'm thinking like gold and silver and maybe some of the emerging market currencies as well going down. That people, that whenever you get into a period of stress, it seems like it's an old joke, but it seems like global investors, step one, get all your money in the dollars, and then step two, figure out what's going on. And that might be a little bit of what we're seeing right now with the strength in the dollar.
So, Jim, then let's talk about the rest of the world, because this was seemingly a brand new frontier and a golden road for a lot of investors over the last 15 months. But one of the first things we heard out of the ECB was a much more hawkish tone in terms of at least relative to even what I think we heard from other central banks. BOJ finally has had a chance. This gets them in maybe off the ledge of their branch to acknowledge that there's inflation out there. Are you more concerned about other parts of the world, which you and we have all discussed, higher rates around the world have also been a magnet to pulling up U.S. rates?
Oh, absolutely. Because go back to the day before the war, what were we talking about? We were talking about the rest of the world having an inflation problem. We were already pricing in rate hikes for Europe. There've already been rate hikes in Japan. That was before the war. Now you've exacerbated that trend. And now we're pricing in as many as 3 rate hikes for Europe going forward. So we're going to continue to see rates move up. What's going to change all of this is end the war, open the strait, get the ships moving. Then we could talk about where interest rates should settle down to. But until then, all the indicators are pointing at more nominal growth driven by higher inflation around the world and higher interest rates.
So higher inflation, but not a real hit to growth, Jim. I mean, it's sort of it's like a tightrope here. So at what point do you think that we're pricing in inflation plus a hit to growth then, or a stagflation sort of environment?
Well, if you wanted a roadmap for what we're talking about 2022. The same thing happened then. Initially, what happened was we had another shipping supply constraint. It was with container ships. Inflation started to move up. Yes, growth fell. We had a negative first quarter GDP in 2022, but we got way more inflation because it went to 9% than we did with growth falling. And the Fed raised rates from 0 to 4% in a year, and interest rates went up, 3 full percentage points. The 10-year yield did in 2022. Again, the same argument there is that you got more inflation and you got slower growth. So we've seen this story before, just 4 years ago. And it seems like we're starting to play that out. Now, it's not container ships like it was 4 years ago. It's tankers that is causing this supply problem.